welcome to Property Question Time. I'm Bryony Billson and this is the show where you get the chance to have your questions answered by our resident property experts. So, let's see who we have in the hot seat today. A warm welcome to Suchit Punnose, founder and CEO of Red Ribbon. We have Paul Mahoney from Nova Financial Limited. And last but by no means least, Satyen Lakhani from OffMarket Investment. My first question is going to go straight to you, Suchit, and it is in regard to purchasing property in India. They've asked, what do I need to be aware of when purchasing property in India as an NRI?
Very broad question, but starting with the same approach as one would have in buying a property in the UK or indeed in any country, for the size of the country, you would look for good locations. I would recommend that one looks at tier 2 cities, which are smaller cities that are growing at the moment, and also offer greater opportunities for both income and capital growth. One of course needs to look to see what sort of investment one needs into India. Is it a direct holding by way of buying a property and renting it out, or not renting it out, or does one go into indirect investments through a property fund, for example? So that's the sort of call. But it's no different for an NRI or an Indian buying a property in India.
Okay, thank you. And you feel like there's not really then any further risks for this person than if they were buying in the UK, perhaps?
Well, I wouldn't say that. I mean, jurisdictional risks are different. So if you look at India, India comes with high growth and therefore there is also high risk in as much as that one needs to know where you're buying and how you're buying it. But overall, the systems and procedures are the same. There's safety to title. You do have quite a few lenders in India that will lend against a mortgage. So it's pretty much straightforward in that sense. But in terms of the risk of the investment, i.e. in terms of rental yield or capital growth, that would vary between a country to country. So whatever is the UK market, global macroeconomics would be different to India. Our argument is that at the moment, if you look at the macro fundamentals, the shortage of homes is about 22 million new homes in India. Therefore, there's a great opportunity there. There are 700 million people moving in from the countryside into cities. It is perhaps the single largest urbanization in the history of mankind, which means 700 million people needs to be sorted in terms of property, housing, and all other related infrastructure. So we always say that if you're looking at diversifying your property investment portfolio, India should definitely be the target after the UK.
Thank you. Okay, Paul. Our question, actually it says hi all from our viewer, but I'm going to ask this one to Paul, but please do contribute afterwards if you like. Our house is on the market. We owe $48,000 on it all. We have seen our perfect home, but they want a quick sale. Our house is on the market for $179,000 and the new one is $215,000. All our equity is in our house, so we have nothing to put down. We're hoping ours will sell soon, but what are the options to release equity to use as a deposit?
Okay. There are a few options. However, given it seems that it's fairly time sensitive to be able to get this property, bridging would be an option. And essentially bridging is short-term lending. That could be secured against their current home, only if, though, their existing lender is okay with it. So they mentioned they owe some money already, assuming that's a fairly standard residential mortgage. Some residential lenders won't be happy with the second charge being put on that property. Some will. So bridging, and the reason I mention bridging is it's the type of lending that happens quite quickly. So, some bridging lenders will tell you they can lend to you within a few days. In reality, it's usually a couple of weeks that you can get that money. So pretty quick in comparison to other options. That would be one option, but it's quite expensive. It usually ranges from anywhere from 0.5% a month through to 3% a month on the amount they need to borrow. And that would give them the money pretty quickly to be able to put down on the subsequent purchase. However, in doing that, they would need to be absolutely certain that their current home is going to sell and that they can get a mortgage on the subsequent purchase. Potentially a cheaper option would be to just approach their current lender and tell them the situation. This is what we want to buy. We need this much money to do it. Will they facilitate it for them? Some lenders will actually allow you to port a mortgage from one property to another. Really, it's worth seeking advice, because of course they could go to their current lender. Their current lender might say yes or no, and even if they do say yes, they might give them some certain terms which may not be agreeable. They could go to a bridging lender, and that could end up costing them an awful lot of money, especially if the process gets drawn out. That's really the major risk with that sort of short-term type of finance, is if things take a lot longer than you expected and you're paying 2 or 3% a month on £100,000, that's a lot of money. So seek advice. I'd say seek advice. Speak with an advisor about the situation that we have there. Obviously, these questions always tend to be pretty general in nature because they have to be. But go through the whole situation, all of your options, assess those options, the costs and the benefits of each, and I suppose that will help you determine the right outcome. A lot of it might come down to how much they really, really want this property.
Yeah, that's what it.
Because they're not quite, in reality, they're not quite in the position to buy that property yet. But if they really want it, then there's probably options available for them to get it.
It's good to know, like they do have options available to them. But I think your advice is very. You're spot on with your advice there, with making sure something with bridging that they don't just go straight in with it if they haven't got all the facts together, and just thinking about this house, because as we all know, things often do take longer than expected.
Yeah, I think Paul's spot on. At least there are options there. Sometimes there may be non-obvious options, which is to approach the developer to see if they can facilitate that bridging facility to companies that they may already be in discussions with as well.
Yeah.
Because if they're motivated to sell, they will see if they can help you. And if you're both motivated on the same subject, same unit, there's a way that you can work things out. Buy perhaps more time, or ask the developer to see how they can bring in a bridger or a lender to help them facilitate the purchase.
Thank you. Thank you. Well, I am actually going to come on to you now for another question. Sachin, I have currently reserved a new flat in London. We're looking to get a mortgage set up with the Help to Buy scheme. We currently have the 5% deposit to do this. We're buying the property off plan, and the completion date is not for another 7 to 8 months. During this time, we're hoping to save up additional funds to pay our stamp duty. So they've actually got 3 questions here. I'll tell them all to you, and then we can go back if you like. The first one is it possible to do this? And then they want to know, do we need to prove we have the funds available to pay the stamp duty? And finally, they want to know roughly when would we have to pay the stamp duty?
Okay. Indeed, there are 3 sections to that. But fundamentally, if they're buying from that developer, is the developer offering the Help to Buy scheme? Usually, new build properties, they usually want 10% on exchange, which negates a Help to Buy scheme, which does it on 5%. So again, they need to ask the questions to that developer. Regarding the stamp duty, yes, they're going to need that money, and they're going to need to pay that on completion. And there's no option there. They have to pay that. It's an obligation. Therefore, again, if they don't have those funds right now, what guarantees will they have? They'll have the funds by the time they complete. And again, this is another area they need to go and seek advice on, because it may well be that they are saving up for this money. So what is their position in saving that allows them to feel they'll have enough money in that timeline to have the stamp duty saved up? And again, this is where financial advisors earn their money, because that's what they're good at in terms of advising the buyer. So again, factors to look into. Don't just feel, yes, I've done it so I can, because things don't end up in that simple manner usually. So on a Help to Buy scheme, you need to find out is the developer offering that, and do they have that? Are they going through that Help to Buy scheme through the developer? If not, if the developer's offering it, it might be wise to look at that option as well, because that will give them, or give the developer security that they're going through an avenue that they've put out there as well, and it'll give them comfort that they'll do it in a certain timeline. So 2 or 3 points there to consider, and all of those invite seeking further advice. And again, I think we've said it enough times, to do it without the emotion of, I really want that property, or the emotion of, we really can save the money for that stamp duty. Ideally, you want to be in a position that you've already got those funds ready and lined up. Then you know you're doing it because you've got it all there. And if it's not there, then why is it not there? Have you processed this well enough and hard enough to say, okay, I'm going to buy a property, but I haven't got all the funds ready? So again, you've got to ask these brutal questions to yourself. Am I in that position to buy this property? If not, what are the what ifs? If I can't raise the money, what would happen? And they're not the questions that you often have the right answers to or support what you're trying to do. Hence, it's important to make sure you've got options lined up to give you the best scenario possible for yourself.
I think it's really clear and really great advice, because for some reason sometimes I think people can go out, they find a property that they fall in love with, and then they line up their finances and they get things straight. But really what you're suggesting to get really clear on and really straight with is ask those difficult questions first, get your finances straight before you even go and fall in love with a new flat in London, so that you already know the answers to these questions before you start thinking differently.
And again, I think bear in mind that you're not totally on your own. That developer that's putting that new project up usually has associations with a selling agent. It may not be an estate agency, it may be an investment company that is promoting that site on behalf of that developer. And usually they'll have options and solutions that you may not know to look to. So you're not totally on your own.
We'll be taking a quick break, but stay with us because we have more questions to ask our property experts and maybe one or two golden nuggets. We'll see you soon. Welcome back to Property Question Time with me, Bryony Billson, and on my expert panel today is Suchit Punnose, Paul Mahoney and Satyen Lakhani. Okay, we're going to go straight to you, Paul, with a golden nugget.
Okay, my golden nugget is fairly topical. There's been a lot of changes with regards to lending on buy-to-let mortgages lately. And the most recent change was as of September this year, 2017, with regards to the way that lenders look at portfolio landlords. And essentially the change is for anybody who has 4 or more encumbered properties, so properties with mortgages, there are more stringent checks being done on the whole portfolio rather than just the property that's being lent on, which I suppose makes sense because you could have one great property and 3 terrible ones, and those 3 terrible ones could have quite a big impact on that one great one, to your overall financial position. So it's important for landlords that do have 4 or more properties with mortgages, and that's an important stipulation because it only applies to properties with mortgages, that you make sure your overall portfolio actually works from a cash flow perspective. A lot of lenders will now require you to have a business plan and a cash flow analysis, and to stress test your mortgage rates to make sure that not only at the current rates your portfolio works, but at slightly higher rates your portfolio works as well. So it's not something to get worried about or to put you off, but again, worth seeking advice on how best to make these changes or to put these things in place to make sure that moving forward, when it comes to remortgaging or purchasing subsequent properties, that you're in a good position to fulfill the lender's criteria. Thank
you. A brilliant golden nugget there. Why do you think they have made these changes? Who is it really benefiting?
It's benefiting everyone, really. Landlords might feel like they're a bit under attack at the moment, but to be honest, it's about making the overall sort of lending market more robust. You know, no one wants another 2008. So by checking, as I say, by checking a whole portfolio, a lender can be confident that that person they're lending to, because at the end of the day, they're lending to the person, not necessarily the property, that their portfolio actually works overall, even if rates were to double or triple. We're in a very low interest rate environment. And I think all lenders and the Bank of England and the Prudential Regulatory Authority are all a little bit concerned as to if rates do increase substantially, what happens. So by bringing these things into place, it helps people better deal with that potential scenario.
Thank you, some expert information there. We're going to move on to one of our next questions, and I'm going to go to Satyen. We're currently looking at a few developments nearby, which all have completion dates of roughly 6 months after release, subject to delays. With most mortgage offers only being valid for 6 months, how do people reduce the risk of the build taking more than 6 months, which seems likely, and having to apply for another mortgage and have the offer reduced, which is possible? Do we need to find a lender who will hold on for, say, 12 months from the offset?
That's a great question. And a scenario that I've come across a few times. And in this instance, I think, again, it's seeking advice from a financial advisor that will put you in the right direction. Most properties usually see delays in completion for unforeseen circumstances. It could be that the kitchens haven't arrived on time. It could be weather issues. There are various factors that delays completions on properties, which will have an impact if they've gone to a mortgage and have a mortgage offer that runs out within a certain timeline. And then what would happen is that the lender would want to send a surveyor in again, and they may change, philosophically, it may change the value of the property, which have an impact on how much they can borrow again. So there are factors that need to be considered. What we find is that lenders usually have a scenario that they can't go beyond a certain timeline, which is called a long stop date, in terms of when they can finish a completion. And if someone, usually on an off-plan property, would have exchanged within a short period of time, so therefore they are committed to that property. So if the developer goes above and beyond that long stop date, then by right they have to offer the buyer whether they wish to proceed or not. If they choose not to proceed, then they can get their money back, the full amount of deposit that they paid as well. But again, they need to seek the right advice from their financial brokers to make sure that they're doing the right thing. By going for a lender to offer a 12-month mortgage offer, again, I think Paul will emphasise this, that's rare to find that position. There are not many lenders that will offer that position. So the key thing is to make sure, the key word in all of this is confidence, that you are confident that that developer will finish the product in a certain timeline to the standard that you want them to in terms of what they've sold to you. And the way to do that, again, is to look at the developer, look at their website, look at what they've done in the past, when they've delivered that, and try and gauge from that whether you'll find it or you're buying from the right person. And then options of finance, always you need those options and seek that financial advice, which I think you'd agree with?
Completely agree with all those due diligence points. And exactly right, most lenders won't give 12-month mortgage offers, most are 3 to 6 months. But in saying that, most will also extend those offers unless something has significantly changed. Often you can get 1 or 2 extensions on that mortgage offer. And yes, that's exactly right, is that sometimes they'll want to send another surveyor, sometimes they won't. But an important thing to consider there is when you're buying off plan and there's nothing for them to actually survey, it's a paper survey, which are always very conservative, which they, by definition, they have to be because there's nothing for them to see. So that mortgage offer doesn't really mean very much because they can always, generally they will be subject to survey at the end anyway. And if they go out and the unit's completely different to what was promised or the very bad quality or whatever it might be, well, it doesn't mean you're getting a mortgage. So when buying off plan, certainly make sure you have the confidence you can get the mortgage. You're ticking all the boxes both for yourself and the lender's criteria. But it's the mortgage offer when the property is completed that actually means something. So it's important to understand that.
Usually you'll find that the developer will give you notice as to when you need to go for your mortgage, and it's towards the latter part of the completion build where the developer has to get the building regulations all signed off, etc. Then they'll serve you notice via their lawyers to your lawyer saying, okay, you need to now seek mortgage or seek finance because in 2 weeks' time we're going to ask for your monies. So you'll have a timeline where you can go genuinely for a mortgage who would be in a position then to survey the property. Because if it's near completion, then they've got a better viewing point. They'll want to go and see the site. And again, if you're buying from a branded developer, that gives the surveyor confidence as to what their build is going to be like. And they can anticipate the completion and the finished product. Because again, when you go from the outset to find an off-plan property, you really want to buy from a branded developer who has a website. They show their finished products, and that give you an indication as to what your property is going to be like as well, and the timelines as to completion as well. So again, there's a lot of factors involved. Don't just go out there, buy blind and hope for the best, because you need to be in a confident position. And the confidence comes from buying from a branded developer. Confidence comes from seeking mortgage advice who gives you options that, yes, you are a mortgageable person, we will want to lend money to you, yes. So that gives you confidence. And then the rest follows its true course by way of your solicitor doing the natural conveyance and the developer showing you where they are in that build process as well. So again, all the way through is confidence. And if you're in that position, you are comfortable. Certainly when you're confident that you're invested in the right place at the right time as well.
Thank you. Confidence is key then with that question. Thank you so much. Okay, Suchit. Quite a detailed, specific question here, but I know you're an expert in this field, so I'm sure it's fine. Our viewer wants to know, I want to buy a property for investment purposes near Madurai. I'm confused about flats and plots. I've no plans to settle there. It's just for investment. Your kind suggestions will be highly appreciated.
I think very interesting. Madurai is a tier 2 city in South India. Where it's a temple city. There's a lot of traffic in for pilgrimage into that city. Now, considering the options the viewer has asked for, whether flats or plots, those are both chalk and cheese. Flats means you have a property, it's ready to go. You can buy and hold, or buy and hold and let out. Plots is totally different. It's almost close enough to land banking. You're buying a plot and you sit on it and hope that the developer would bring in the common facilities and infrastructure, and you can then later on either develop or sell on the land. It's just a question of what the person wants to do. It both have got its pros and cons. The flat, of course, is completed. That means the developer has made the margin on the construction. You now have to wait for the rental yield and the capital growth to kick in. If it's a plot, then you have the option to do a design of your own choice and build it, and therefore get the developer's margin. And if you don't want to sell it, you can then also hold on to it. So that then becomes a personal choice. From the sounds of it, if it's purely investment, and if that person is doing it for the first time, it may be advisable just to go with the straightforward purchase of a flat.
Thank you. Thank you very much for your advice there.
Just one comment on that, and this isn't necessarily specific to India. It's buying property anywhere. In my opinion, a plot isn't necessarily an investment. It's a speculation, whereas a flat is, because a flat would actually generate you an income, and then of course hopefully give you some capital growth as well. Whereas buying a plot is almost like buying a commodity. You're hoping that other factors will increase the value of that plot, as opposed to it actually generating you an income over that time frame.
Thank you. That was a really great extra bit of information there for that person to consider. So my last question actually does go to you, Paul. And they say, I own my flat, and now want to help my partner to buy their own property too. We don't live together. Therefore, if we were to apply for the mortgage jointly, but only my partner, who doesn't own any other properties, is solely on the property deed for the new property, is the second home stamp duty still applicable?
Okay. All right. There's about 10 things to consider in that question.
What's the real question?
Right. So let's go through it bit by bit. I might need you to recap a couple of bits of the question. But firstly, something that will be quite important in this question is whether the partner, whether they're married.
Yes.
Because if they're married or not, that makes a big difference. Secondly, the property that the one partner is looking to help the other partner buy, are they going to live in that property together, or are they going to continue to live separately? Because that will determine the type of mortgage that they'll need on either their property they already have or the one they're going to buy. Thirdly, they've mentioned that the property will be bought in the new property buyer's name, but both will be on the mortgage. A lot of lenders wouldn't be happy with that. Some lenders might be, but generally to be on a mortgage, you need to be an owner of that property, because by being on the mortgage, essentially you are what they call jointly and severally liable for that mortgage, and therefore for that property to be sort of foreclosed on if you don't repay. So if you're not an owner, how does that actually affect you? So quite a few things there. And then lastly, so far as the stamp duty premium, what will determine if that applies or not is if they're married. So far from a tax perspective, the HMRC considers a married couple a joint entity. So if they're just boyfriend and girlfriend and they're buying separately, and it's that subsequent buyer's first purchase, then no, it wouldn't apply. But pretty well all of those points I've just made do depend on whether they're married or not, and the use of the new property. So I haven't really answered the question, but I've given some points for consideration.
Thank you. No, you're right, there was a lot going on there, and you've done a really fantastic job of kind of addressing some of the potential further questions.
So hopefully that helps them consider their points, and then they can potentially seek some personal advice on their actual situation.
I think it's a classic scenario of ducking, it's not you, it's me scenario.
Yeah.
You know, you want to end it as a way.
Yeah.
It's a simpler way to do this.
Well, talking of endings, I'm afraid that is all we have got time for today, gentlemen. Thank you so much for coming in and giving all your fantastic advice and information to our viewers today. If you have a question that you want to ask, then please email us at info@propertytelevision.tv, or you can download our app or go to the website property-tv.co.uk, and we look forward to seeing you next time.